The latest CPI or Consumer Price Index numbers have been released. And basically, they show that inflation is now rising at its fastest rate in almost 40 years. Between March and April of 2021, inflation started to rise at a faster rate than we are used to seeing. And by May of 2021, inflation hovered around the 5% mark. And last CPI report, we saw inflation go all the way up to 6.2%, and now it is even higher than that. So today I want to talk all about this most recent Consumer Price Index report and what it means for inflation and how that is going to affect our economy and our growth in 2022. I also want to talk about some things that could happen now that we are seeing inflation rising even faster than expected. But before I get into all of that, my name is Nate from Minority Mindset News, and if you like this video, then smash that thumbs up button below and hit that notification bell too. That way YouTube shows our videos to way more money minds around the world, and we can keep making videos just like this one. Inflation has been high in the United States for what feels like forever. But how exactly did we get here? Well, inflation is something that typically happens when your economy is healthy. At least according to the Federal Reserve, a good amount of inflation is around the 2 to 3% mark. This means that everything in the United States is starting to cost around 2 to 3% more. So if something costs $1 today, a year from now, it might cost $1.02 or $1.03. That would be 2 to 3% inflation, but in March of 2020, things got a little out of hand, and you can probably guess why. The pandemic. The pandemic pretty much closed down our entire economy and kept people out of work for several months. This meant that nobody was really making any money, and businesses weren't going to be making any money either. So this is when the Federal Reserve decided to step in and print around $3 to $5 trillion in stimulus. The Federal Reserve, of course, is a private entity and not actually linked to the federal government of the United States. They are not in charge of printing the money. They are just in charge of monetary policies and then give those policies to the Treasury Department. Of course, the Treasury has its own policies too, but the Treasury Department actually prints all of the money. The reason for this is because if the Treasury Department made all of the monetary policies and it printed the money, well, that might be a little bit of a conflict of interest. So the United States government created the Federal Reserve Bank all the way back in 1913. Now, it's important to mention here that the Federal Reserve Bank is not really a bank, and it's not really a reserve either. The Federal Reserve is in charge of how much money is printed in the United States. Now, we're going to come back to the Federal Reserve a little bit later on in this video. However, when the pandemic began back in March of 2020, the Federal Reserve printed $3 to $5 trillion. Essentially, this was a way to incentivize people to spend money. They were going to give people thousands of dollars in stimulus checks, give extended unemployment benefits, and for businesses, the federal government launched the Paycheck Protection Program. So if businesses actually held on to their employees throughout the pandemic, the federal government would give those businesses money. This was all in an effort for people to keep their jobs. And when people have jobs in the United States, they tend to go out and spend their paychecks. Spending money in the United States is good for the economy. It's how our capital system works, and it means businesses can continue to grow. The system basically works by you get money from your job, and then you go out and buy things with that money. That money goes back to businesses, and it kind of continues to cycle through there. That was the start of our inflation problems, though, because the definition of inflation is when your monetary supply starts increasing rapidly. And the Federal Reserve over the last 2 years has printed around 20% of all of the dollars that are currently in circulation. That is faster than we have ever seen in the past. We have thrown more money at this pandemic problem than we have for pretty much every crisis in our nation's history. Yes, even more than the Great Recession. So our monetary supply is increasing, but who cares, right? Why does it really matter if our monetary supply is increasing? I mean, isn't this actually a good thing? If the Federal Reserve prints so much money, then that means people have more money to spend. And in a vacuum, this can be a great thing. However, The symptoms of inflation are a lot more complicated than that, because when you print more money, that means there is more money in circulation. And when the nation has more money in circulation, people have more access to it, and they go out and spend this money. Now they're buying more products from businesses, and businesses only have so many products that they can make. They have to continue to expand and grow, and all of that costs money. They have to get more employees. They have to open up more factories. They have to have bigger delivery costs. None of that is free, so eventually they do pay more to provide more for the society whose demand is very high. Remember, supply though is very low. When these businesses pay more, they eventually trickle that price down to the consumer, which is why something that costs $1 today is most likely going to cost $1.02 or $1.03 next year. Inflation typically happens very slow at a 2 to 3% rate. However, over time, you can see how this could become a problem. And right now, we are experiencing levels of inflation that we haven't felt in nearly 40 years. And because nobody knew exactly how long the pandemic was going to last for and how long people were going to be out of work, the Federal Reserve went one step further and dropped its benchmark interest rates to near 0%. Now, what this means is that if you wanted to get a loan, you could get a loan with a much lower interest rate. So people could afford to get a mortgage or an auto loan that they might not have been able to afford before. If you have bought a house, then you know a 1% interest rate on your mortgage could mean saving hundreds of thousands of dollars over the lifetime of your mortgage. That's right, if you get a 4% interest rate versus a 3% interest rate, you can save hundreds of thousands of dollars. So the Federal Reserve dropped its benchmark interest rates so that people would go out and get loans. Now, that money has to come from somewhere. It's going to come from banks, and it's going to come from other financial institutions. And the Federal Reserve has to print more money so that banks and financial institutions can have money to give out. That means inflation is going to go up, and it means that more money is circulating throughout your economy. However, it also means that the buying power of your money and the value of every single dollar within our economy is going down. What I mean by this is when the Federal Reserve decides to print more money, every dollar that you have in your wallet or in your bank is essentially worth less. Think of it this way. If there are $100 circulating throughout our economy and you have $1, that means that you hold 1% of all of the wealth in our economy. However, when the Federal Reserve decides to print an additional $100, now there is $200 circulating in our economy. Your money is not worth the same that it was before, which means you can't buy all of the same things with the same amount of money. You no longer have around 1% of all of the wealth, you have more like 0.5%, and now you need $2 in order to buy all of the same things. That is basically how inflation works, and when the Federal Reserve dropped its benchmark interest rates, when it started to print trillions of dollars in economic stimulus, this meant that people had a lot more money. And when people have a lot more money, the majority of them go out and spend this money. Now, to be completely fair, we saw saving rates in 2020 and in parts of 2021 skyrocket. People were saving a lot more money than they did before, and we also saw people invest more money than we've seen in a long time. The Dow, S&P 500, and NASDAQ have all hit new record highs multiple times over the last 2 years. People are investing and saving their money. However, around 50% of all of the stimulus money that was printed was spent in about a week after it was issued. Over the last 2 years, demand for everything has been growing in the United States. Demand for products, demand for services, demand for housing, because Americans have a ton of money right now. The majority of Americans will spend this money if they have it. One of the biggest issues that we're running into today, though, is supply chain issues. Because Americans are spending so much money right now, our suppliers and businesses cannot keep up. So they have a very limited supply of things, and there is a huge demand for everything. I talked a little bit about when the Federal Reserve dropped its benchmark interest rates and housing exploded from there. This is because people were going out and getting mortgages. Interest rates were so low that now they could afford to get their dream house or just a house in general. They could actually go out and get a mortgage and pay less than they could before. So housing prices quickly started to surge because there were just not enough houses on the market to meet demand. That meant that houses that were on the market were usually selling pretty quickly and for way more than they might have been valued at just a few years prior. By early December 2021, the housing market has started to cool off. However, housing prices are still valued 20% more than they were just a few short months ago. And like I said at the beginning of the pandemic, we saw unemployment start to spike because people were out of work. Now that has steadily improved throughout the pandemic, but now unemployment has hit a new record low. Unemployment in the United States is around 4.2% right now. That is the lowest that we've seen since 1969. But this also poses a few problems for our economy. Everything is starting to go up in price because demand for everything is very high right now. Part of the reason for this is because so many people are employed. When people have steady income, they can now go out and buy a lot more things. However, just about everything in our economy is very expensive right now. According to the November CPI report, inflation went up by around 6.8%. This is a massive increase from what we saw in October of 2021. The CPI, or Consumer Price Index, essentially takes all of the prices in all of the industries in the United States and gives you an average increase or decrease of how the prices are going. And as you can probably imagine, prices have gone up for just about everything. If I look at the numbers here for our most recent CPI report, we can see that on average, prices went up by 6.8%. Now that is accounting for every single industry in the United States, goods and services. However, core CPI, which excludes food and energy prices, only went up by around 0.5%. Now this is right on pace with what some experts have predicted. However, for most Americans, energy and food is one of our biggest expenses. Energy prices alone are up by around 33% since November of 2020, and gasoline is up by 58.1%. That is a massive increase. Food prices are up by over 6% this year, and used cars and trucks are up by around 31%, which is insane. Usually used vehicles only lose value every single year. They don't really gain value. But the reason that they are gaining value right now is because of our supply chain issues. One of the biggest factors in car manufacturing is a semiconductor. These are little chips that go inside of the car and basically control all of the car's electronics. And most of our vehicles nowadays heavily rely on their electric components. So without these chips, new vehicles could not be made. So people started to turn to used vehicles when looking for their new car. That means even the auto industry is suffering from our supply chain issues. New cars are hard to come by, and if you can find a new vehicle, it's going to cost you. And used vehicles are also hard to come by, and if you can find one, it's going to cost you. Housing and shelter costs have also increased by around 3.8%, which is the fastest increase since 2007. So the price of just about everything in every industry is starting to go up. But what exactly does that mean? Well, that means that Americans all throughout the country are going to have to pay more for every single good. This is not a promising fact for our economy, because if Americans have to start paying more for everyday goods and services, incomes are going to have to start rising as well. Now, for most Americans at most of their jobs, wages and incomes typically increase every single year. I'm sure a lot of you are familiar with the 2 to 3% raise. This 2 to 3% raise is very common, and it means that Americans are making more money every single year. However, a 2 to 3% raise conveniently links up with what the Federal Reserve considers healthy inflation, remember, which is 2 to 3%. That means for most Americans, when you get this 2 to 3% raise, you're not actually making any more money, because remember, as inflation goes up, everything else goes up in price too. So even though you make 3% more money, the buying power of all of that new money is essentially the same. The only way you can beat inflation is if you're making more than whatever the inflation rate is every single year. So for instance, if inflation is 2%, you'll need to make 3% or 4% or 5% in order to officially start beating inflation. Here's the thing though, because inflation is so high right now, businesses and companies have started to shell out more money for their employees. According to this new CPI report, wages have gone up by around 4.8%, which is actually pretty good. However, it is not keeping up with what inflation is. If inflation is at 6.8% and you get a 4% raise, you are making more money. However, you're still in the hole. That is a massive problem, and it has led to 41% of Americans becoming very worried about our economic status in 2022, with most of them believing that our economy is going to get worse. So that is the Consumer Price Index report, but now what does all of this mean? Is there anything that we can do about inflation, or is inflation just going to continue to rise forever? Well, there is a couple things to consider here. The first is the Federal Reserve. I told you we'd be talking about them again. The Federal Reserve is in charge of monitoring inflation. They make monetary policies that will either heighten inflation or drop inflation down. As the money supply was increased in 2020 and in parts of 2021, inflation naturally went up. Now, most experts believe that the inflation that we're feeling right now is mostly due to our supply chain issues, but remember, Americans had so much demand because the Federal Reserve printed so much money. And then they basically just gave it out to people with no strings attached. But that's not the only thing the Federal Reserve did. They also printed trillions of dollars in their quantitative easing program and bought bonds and treasury notes on Wall Street. The reason for this is because they didn't want Wall Street to fail and continue to crash. In March and April of 2020, the stock market crashed. We saw the fastest stock market drop in stock market history. Investors knew that businesses weren't going to be making as much money because people were out of work. Millions of investors wanted to protect their money and they got scared. So they pulled their investments from Wall Street. They wanted to take their profits now while they still could. This is a lot bigger than just investors on Wall Street though, because you've got to think, what are investors actually buying on the New York Stock Exchange? They're buying shares of companies. This is quick liquidity and capital that these companies and businesses rely on in order to function. And we're talking hundreds of billions of dollars being pulled out in a very short period of time. So businesses are losing a lot of that money, which hurts their growth and profits, which hurts their ability to grow and scale. This could potentially mean closing down factories, closing down shipment lines, firing employees, or laying them off. And we saw that happen in 2020. The unemployment rate hit a record high that we hadn't seen since the Great Depression. That is exactly why the Federal Reserve decided to enter the market and buy bonds. They pumped so much money into the stock market that it had no choice but to go up. However, now we are at the end of 2021 and inflation is getting worse and worse and worse. The Federal Reserve now has a big decision to make. Do they let inflation just continue at this same rate, or do they do something to stop it? In 2020, all of this money was printed to incentivize people to spend money. That way more money was circulating throughout the economy. However, now the Federal Reserve might want to stop people from spending money. And one of the ways that they do that is by raising interest rates. If interest rates go back up, this means that a lot less people will be able to get a loan. Remember that mortgage example I gave you earlier. If you wanted to get a house and the interest rate was super low, you could probably afford that house. However, if that interest rate goes up by 1, 2, or even 3%, you can no longer afford that mortgage. So what are you going to do? You're not going to get a mortgage, or any loan for that matter. Ultimately, that could bring the housing market back down, and it could bring the auto market down as well, because a lot of people aren't going to be able to afford brand new vehicles. The other thing they can do is start tapering their bond buying and asset purchasing on Wall Street. And they've already talked about doing just that, but Wall Street isn't going to like that. Think about it. This was billions, if not trillions of dollars that the Federal Reserve was pumping into the market and buying bonds, which only helped companies on Wall Street. And it made investors very interested in the stock market because everything continued to hit new record highs. However, as that money starts to disappear, companies are going to be losing a lot of capital. That could make the stock market shrink and in turn push a lot of new or even veteran investors away, at least temporarily. Those two moves alone could help inflation a little bit, and it could help lower inflation because with a lot less money circulating throughout our economy, demand will start to go down. It'll be forced to lower because people don't have as much money. This could give businesses enough time to start producing more products, and we could have an equilibrium within our markets. That could lower inflation, but there is one more thing that we haven't considered here. The Federal Reserve printed a ton of money over the last 2 years. More money than we have ever seen in such a short period of time. Inflation, by definition, is when the monetary supply of a country is raised. And the Federal Reserve did exactly that. So even though most of our issues with inflation are because of supply chain related problems, all of this money printing is also a problem. Now, how much of a problem it's going to be, we don't really know yet. We don't really know how all of this money is going to affect the economy, but eventually it has no choice to. Fact of the matter right now, though, is that Americans are struggling to pay their bills. They're struggling to buy everyday goods and services. They are not making enough money. And as they make less money, they're going to buy less. And as Americans are slowly pushed out of markets because they simply can't afford to buy things, that means less profits for these big companies and businesses. Less profits for businesses, especially coming off of record highs in 2020 and in 2021, means that you could see stock prices for businesses ultimately drop too. So what the Federal Reserve decides to do with inflation is ultimately going to affect everyone. It's going to affect the housing market because if people can't get mortgages, home prices are going to start dropping too. It's going to affect the stock market because if profits start to disappear and all of this bond buying and money that has been pouring into markets disappears too, stocks might go down as well. And it's going to affect the everyday American because if prices continue to get out of control, then we're going to see some massive inequality. People won't be able to buy everyday things because not everybody is getting paid to meet inflation. So the Federal Reserve has a big decision at their next meeting, which is in mid-December of 2021. And honestly, I'm not really sure which direction they're going to take. A lot of experts are saying that they have no choice but to bring back their tapering even faster and raise interest rates even more in 2022. However, they have to be very careful about how fast they do this, because if they do it too quickly, that could bring markets down too fast, and if money comes out too fast, that's when you see a crash. On the flip side, Americans are struggling, so if they do it too slow, businesses are going to fail too because people just can't afford anything. And the only other option is for businesses to raise wages even more so that they can afford to buy things, but that will make inflation get even more out of control. It has been a long year, and 2022 is already shaping up to be a long year, and it hasn't even started yet. But one thing that we absolutely cannot deny and we can't ignore is that inflation, and me personally, I don't think the solution is to do nothing. But I want to hear from you on this issue. What do you think is the solution to our inflation problems right now? Do you think that the Federal Reserve should change its monetary policies to bring down inflation, or should the Federal Reserve just let it ride and stop interfering with inflation and our prices in general? In addition, how do you think 2022 is going to shape up? Do you think that inflation is going to get out of hand next year, or do you think that inflation will steadily drop to a normal 2 to 3% level? Whatever your thoughts are, leave a comment below before you go. But that is it for today's business and financial news breakdown. Thank you so much for watching. If you like this video, make sure to hit that subscribe button below. Keep hustling, Money Minds, and I'll see you all in the next one.